Good morning, welcome Dornbush download number 34. Andrew, Michael, good morning. Just talking about Marlon Brando. These are all unscripted in case you hadn't guessed. Michael, tell us the Marlon Brando story.
Well, we were just discussing about there's usually a bit of information that we sort of, regurgitate, I suppose, for want of a better word. But yes, apparently back in his old acting days, Marlon Brando would actually have the words or his lines on a sheet of paper stapled to his co-actor's chest or back or however the profile was. So, yeah, interesting. We're sort of wondering whether we could get away with that or not. But,
so I can assure you that's not happening. And as you can see, we're in our winter warmies. It's a bit cool here in Toowoomba at the moment. Anyway, we're not here talking about acting or the weather, we're talking about shares, surprisingly. Michael, you've done a fair bit of work this week, so I'll let you run with it. What's been happening?
Yes, Andrew. No, I think certainly yesterday we heard from the Reserve Bank of Australia bringing out their minutes. I guess a bit more background about their decision last month, of course, which they held interest rates on hold, which was a bit of a surprise across the board. But certainly, Andrew, that the tone of the minutes much more dovish, and certainly, unless the CPI figures that come out today are extraordinarily high, the general thought is that we will see another interest rate cut in May.
First Tuesday in May, or first Tuesday of every month, so only a couple of weeks away.
Yes, no, RBA very concerned that mining and non-mining investment continues to fall away, and certainly export levels of bulk commodities, iron ore, coal, are also under some pressure. So certainly there's been a lot of talk about house prices, particularly in Sydney, and the RBA seems to be reasonably comfortable at the current state. So unless there's an exorbitantly high CPI figure, probably in the next hour or so, or half an hour even, looking like the RBA probably leaning more towards a cut, and maybe next month.
And great for us from a share market point of view, but if you're a self-funded retiree, one of the 2.2 million of them, you're getting 2.5–3% on your cash. Not a happy outcome at all.
No, and again, historically, interest rate levels have been the lowest basically ever. So
forever.
Unprecedented. So, but yes, Andrew, watching a couple of stocks, it's a bit tough buying in this environment. It's a little bit toppy, a little bit volatile, but a couple that we've been looking at, Bellamy's, listed back in August last year at $1, currently at about $3.50. So it's had a pretty good little rally up.
Wow, that's huge.
Yes, and of course Bellamy's organic baby food and formula.
We spoke about that one in one of the early Dornbush downloads. I think it was about 130, 140. I hadn't looked at it for a little while. 350.
Yes, 350. Had a big run the last couple of weeks even. So, certainly a stock that's very much on the top end. They had a pretty good half-yearly result. Profit up 130%, around about $3 million for the half year. No dividend at this stage, but of course, looking at expanding into those Asian markets. And China had that unfortunate incident there with that baby formula was a bit off, caused a lot of grief. So those sorts of markets really opening up for Bellamy's. Whether you'd buy it at $3.50, probably not. I'd like to see it consolidate back to that sort of support level at around $2.80, even better at $2.20. Whether it gets to that or not, I guess, is anyone's guess, of course. But one to keep an eye on, and if there is general weakness, certainly one that we think's got some great potential, particularly if they can keep expanding. Probably the second one, Andrew, Ramsay Healthcare. They've had an extraordinary run the last few years, and certainly that medical services, healthcare sector is one of particular interest, I think, here in the business. Ramsay just starting to turn a little bit downwards, and that's good, of course, if you want to try and pick a few up, which I think is worthwhile keeping an eye on. Currently at about 64. Entry price for me is about 55, so we're looking at a $10 drop, and again, whether that's sort of feasible or not, but again, one to keep keep an eye on.
I don't think it's unreasonable. The healthcare sector's up about 13% for the year. It's one of the calendar year. It's one of the better performing sectors. So if you're looking for about a 15% drop, even if it was to retrace a bit, you might not get your magic entry price, but you'd certainly be more than halfway there.
Yeah, absolutely, and of course, if you did get to those levels, you'd be loading up. Absolutely, not a great dividend payer. And certainly current price is pretty full PEs, about 30 times, but quality business. 150 odd hospitals. I think it's a bit over 60 in Australia. So again, expanding overseas.
And in Europe, and we've got a thing we'll tell you about in a couple of weeks' time, which is going to have a little bit of a European focus. But the people we were talking to this morning, their big picture outlook was quite positive. You were saying on Europe.
It was, yeah. From their macroeconomic gurus at their end, they see pretty positive things coming out of the European, the European economy. They've got some headwinds in the short term, of course, and Greece, which has sort of been...
Greece is the word.
It has been the word for a good number of years now. So
I'm not going to sing for you, it's okay.
So, once they get that sorted, I think, I think that's their sort of their thoughts that, once they can get that sorted, there's some good upside.
And there's that ETF that Dan and I were talking about last week, that IEU. I even learned it this week for you, April. IEU. So, again, if you're trying to play that European space, that might be one to think about as well.
Absolutely.
Anything else you wanted to cover off on?
Not too much else, Andrew. I guess the next big thing for us is bank reporting season coming up towards the end of April, early May. So, yeah, just be interesting to see if those guys can meet expectations. Those expectations pretty high at the moment.
And that BOQ result, I think, was a great portend, or great predictor. Had run up really hard into the result. It wasn't a bad result, but because it didn't meet that expectations, share price got sold off. Bendigo, I think, was the same. And certainly banks, as we've been saying for a number of weeks now, certainly very fully priced. We are acutely concerned about their provisions for bad and doubtful debts. They're probably on average 10 to 15% overvalued. For clients who have no bank exposure, happy for you to do some buying. But I mean, I've got a client who I was talking to yesterday, 75% banks, too much. And that's, sorry mate, didn't mean to hit you there, but it's simply by virtue of the fact they bought at the right price 3 or 4 years ago when everyone hated banks, that they've had such great growth. You need to be winding that back, because otherwise, not at the moment, we're talking about interest rates falling, but at some stage, this is not a sustainable environment.
Yeah, absolutely.
All right, thanks very much, Michael. Anything else?
Yeah.
You're great.
No, that's it, Andrew.
Perfect. Until next week. Thank you.
Thank you.